So a couple of years ago, super investor Ray Dalio, he ushered the words "cash is trash," and this led a lot of folks to start to think about cash maybe a little differently in regards to investing, and that most of your money should be invested at all times. And so today, I've noticed recently more and more folks starting to talk about cash is trash. You need to have your money all invested, right? And so I thought, let's go through this. I'm going to warn everybody, this is going to be a data overload for you here today. I have so many slides prepared for you. I'm about to give you so much information. Your brain might just go, you might start shaving your head like I did. It's a lot here today, folks, okay? We're going to talk about, is cash really trash? Now, I believe people start talking about uttering this phrase, cash is trash, when there's a couple phenomenons that are happening. One is the market's doing really well. Because you look at the NASDAQ, for instance, the NASDAQ has increased 33% in the past 1 year. So when you think about, okay, at this time last year, if you just held your money under your mattress or something like that, right? Or in a checking account, versus if you had just to put it in the NASDAQ. We're not even talking about picking individual stocks. We just put it in the NASDAQ. You would have gained 33% on your money in the past 12 months, right? Meanwhile, those dollars are always being devalued, not because the NASDAQ's going up, because literally the money's rotting because of inflation over that period of time, right? And that leads us to the second reason I think a lot of people talk about cash is trash is because when you're going through periods of high inflation, right? This leads people to say, you know what? Why would I have cash? Cash is trash. My dollar's being eroded. Go to a food store in 2024 versus going to a food store 10 years ago, right? 5 years ago for that matter. And you're going to find that, man, it takes a lot more of those dollars to go to that food store now to get the same exact things than it did 3 years ago, 5 years ago, 7 years from now ago, or 10 years ago, right? Now, if you look at this very important red line I have drawn across here, if you ever go below, this is inflation rate, if you're ever below that red line, cash is extraordinarily valuable at those particular times, right? Because this rarely ever happens, and so cash in those rare opportunities becomes the most valuable thing in the world because you're able to then take that cash and buy assets for incredibly low prices, stocks, real estate, other assets in general. And it's very rare this happens, and it usually only happens for very short periods of time. It's actually considered deflation during that time. Happened during the Great Financial Crisis, happened in the Great Depression, and a few other times. It's rare it ever happens, but for the most part, the more significant you are above that red line, the truth is cash can be trash, okay? This is a beast of a video here today, guys. All I ask in return for this one here today, my voice is hurting a little bit, can't talk too loud. All I ask in return, smash a like on this video and make sure you subscribe to the channel, okay? It's a beast of a video here today. I think I got 50 slides prepared for you guys. It's an animal, okay? Got a brand new workshop for you guys. I recorded this 2 weeks ago. 7 steps to 7 figures plus in stocks. Pin comment down there for access to that. It's going to take you through each of the steps. I'm going to teach you growth hacks on how you can scale much faster. It's also going to teach you exactly how to implement each of those 7 steps, okay? Very valuable workshop, about a 32-minute video down there, okay? So where I want to start out here is I want to take you through our weekly investor report in the private group and show you a couple of very important details. One's going to shock you, blow your mind here today, okay? And we put out this report to the private group members every week, and the reason being is everybody's got busy lives. There's not many people can really focus on the market full time like I can, right? So people got jobs, they run businesses, things like that. So we want to put together a report every single week to kind of like catch you up so you can spend 10, 20 minutes looking at this and be pretty caught up on, okay, here's where the market's at, here's where things are at, right? So the first thing I want to show you that's very interesting is AI investor sentiment and a major shift that has happened. A major shift has happened over the past few weeks. Now, AI investor sentiment looks at the next 6 months and expectations for investors for where they think the market's headed for the next 6 months, okay? Now, if you want to look here, 3 weeks ago, we were at bearish. 34% of folks were bearish on the market for the next 6 months. Then it moved down to 32.5%. This past week, 23.8%. So clearly people are becoming less bearish in the market. Now, I also put an LOL here because you can see how quickly sentiment can change. Look at this. Between the 1 year bearish high and the 1 year bullish high, it was less than 2 months. Less than 2 months. We went from a situation where in November 1st, 2023, over half of investors were bearish on the market for the next 6 months versus Literally less than 2 months later, over half of investors were then bullish on the market for the next 6 months. I mean, just, you can't make this stuff up, right? Now, it's important to understand recently, I'll put it to you like this, okay? So there's a certain amount of people that are almost always bullish in the market. We call those folks perma-bulls, right? There's a certain amount of folks that are almost always bearish. They almost always look at everything in the negative light. So perma-bulls, or, Tom Lee, I think, is a perfect example of a perma-bull, right? He pretty much always looks at everything as a positive, like somehow everything's got a positive spin. There's plenty of perma-bears out there that it seems like everything, and I don't want to mention names, but there's definitely some folks out there I can think of off the top of my head that seem like they're always bearish. They can always look at things from the negative angle, right? But then you got a certain amount of folks that are kind of in the middle, right? I call these folks independents. Kind of like in politics, you have a certain amount of people that are diehard Republicans, a certain amount that are diehard Democrats. They're always going to vote Dem no matter what, or always vote Republican no matter what, right? Doesn't matter what's going on, they're always going to vote that way. But the independents can actually make up who wins and loses elections because they'll change their mind. Sometimes they're bullish, sometimes they're bearish, right? And so, same exact thing in the market. And right now, we got a lot of people that are neutral on this market, way above normal. The historical average is 31.5% of market participants are neutral on the market. They're not bullish, they're not bearish. Right now, we're at 35.4% this past week. So clearly, this is like people basically saying, you know what, we're confused. We don't really have conviction that this market's going up over this next 6 months. We don't really have conviction it's going down either. We were just confused. That's what these folks are right now, right? You look at the CNN Fear and Greed Index, which is a very popular, index that kind of measures are people feeling greedy in the market or fearful. It confirms there's no direction in this market right now. Look at put to call ratio. It's in neutral territory. Market volatility, neutral. Safe haven demand, neutral. Everything. There's no direction whatsoever in this market. Small business optimism index. This is a disaster, folks. Have you seen how bad small businesses are really being hurt? This is shocking. The small business optimism index decreased by 0.9 recently, right? It's the lowest level since December 2012. When you got to go back to 12 years ago to say this is the worst number since 12 years ago, folks? No bueno. That's bad. Small businesses are not in a good spot. Meanwhile, you have a lot of these big companies doing phenomenal. Look at the S&P 500. Remember, we're not even halfway through the year. And look at some of these stocks. 181% return so far this year. 141% so far this year. 84%, 79%, 58%, 51%. You'd be flipping my flapjacks. Look at the Dow 30. Look at the top 10 stocks. American Express, 27.6% gain. Amazon, nearly 25% so far this year. Merck's at nearly 20%. Caterpillar's at about 19%. Goldman Sachs at 18%. The worst one of that top 10 is Procter & Gamble at 13%. I mean, heck, we're not even halfway through the year. So what's Procter & Gamble's return by the end of the year? 30%? At this pace, that's insane, right? If I look at the public count in the past 12 months has basically gained over $600,000 in value, right? Now, if we look in the past 2 to 3 months, the public count's down about $200,000, which goes to show you the discrepancy between what's happened over the past year versus what's happened really in the past 2 or 3 months. Now, you look at a stock like Shopify. I think Shopify is one of the best stocks to look at if you want to feel, is the market feeling risk on or risk off? When people want to take risk, they want to own Shopify. They say, you know what, got to be in Shopify. We're going risk on. We're risk on. This stock's going to do phenomenal. As soon as people start to feel, you know what, I'm a little worried about the market. I'm a little worried about things. They jump out of Shopify stock. They dump that stock so fast it's not even funny. They say, we don't want any piece of this. And that's why that stock has gone down over 35% in the past 3 months. Because investors have said, you know what, risk off, we don't want it. And they dump the stock. We watched this phenomenon play out 2021 to 2022. You look at 2021, Shopify stock's $100+. Look at 2022. The stock price fell over 70%. It was down to what? Under $30 at the lows Shopify was, right? So that goes to show you, oh boy, the market really, really has gone risk off now at this point in time. Shopify shows it, right? Also, Bitcoin's even shown weakness here recently. Bitcoin hit a high not too long ago, and now it's just, kind of been, come back one day, and then next thing you know, it drops right under. I think Bitcoin's another phenomenal thing to look at if people are feeling risk on, risk off. As soon as people start feeling risk off, They dump their Bitcoin. It's not even so fast. It's not even funny. As soon as people are feeling, you know what? We're feeling good. They buy up Bitcoin, right? You can see that trend. Look at what happened to Bitcoin from 2021 to 2022 when people went risk off. Bitcoin price fell 70+%. Then people started going risk on, starting the end of 2022, leading into the beginning of this year. And look at Bitcoin. It went from like 20,000, I think it was under 20,000 at the lows, to 70,000 plus at the peak. Now, old man sent me this over. This blew my mind. University of Michigan Consumer Sentiment. They've been doing this for decades and decades and decades. It basically is a tell on how the consumer is feeling out there, okay? We just had the biggest miss, it looks like, on record. That's crazy. Crazy. It's one thing for the numbers to come in worse than expected, but it's another thing for the consumer sentiment numbers to come in so bad that it's the biggest miss on record. Like that's nuts. That's not good. That means people, the consumers, have started to feel a lot worse very recently, folks. A lot worse. Now, Mav was showing this recently in a video, and he was talking about XLU, which is basically utilities. And he was basically kind of making a point that utilities can give you a major warning that, problems in the economy are coming, problems in the stock market are coming, right? And it's usually when you see XLU severely outperforming the S&P 500, right? And so very recently, we have seen a phenomenon where XLU is starting to beat S&P 500 quite considerably, right? And he kind of showed in the past the 2022 bear market, obviously GFC, .com crash, and those sorts of things, right? And there is a major divergence. There's no doubt about it. Look at XLU. This is he backed this up to kind of like around, we can call it the beginning of April. And look at XLU is up 8.5%. Utilities are killing it recently. The S&P 500 and NASDAQ have both actually gone down slightly during that time period. So it is one of those things. It's not an end all be all, but it is something to factor in there, right? Now you look at the unemployment rate, right? The unemployment rate is still very low. We all know this, right? But there's a couple problems here. One is the unemployment rate factually is starting to go up. That's the one issue when you have unemployment rate of 3-4%. Well, actually, there's two issues. One could be wage price spiral that you could get into. But the other problem is when you're at 3 to 4% unemployment, it starts to feel like it only gets worse from here. You're not going to 2%. When you're at 3 to 4% unemployment rate, it's only getting worse. And it's a bad feeling because it's like, how long until it gets worse? And we go to a 5%, 6%, 7%, 8%, 10% unemployment rate. And it's kind of like a tick, tick, tick situation where you're just stuck there waiting for it. It's like, dang, it doesn't get any better than this, man. That's the one thing that kind of sucks about it. So that's to factor in there, right? But here's the thing, right? And by the way, that Rona situation, that was obviously like a fake massive skyrocketing unemployment. I don't even really factor that in, right? We've kind of been on a low trajectory for unemployment. I'll fix it for you, okay? This is a reality of the unemployment rate in the past 5 years, okay? Take out the Rona situation where the government shut downs and then all the jobs came right back. That's a fake out situation. This is a reality. We've been in the 3s to 4s for a long time, but the trend is starting to get worse, right? Unemployment is starting to tick up, and that's not a good thing because you don't know when that stops. The dominoes start falling the wrong way, and then you don't know. Can you stop it at 4.1%, 4.5%, 5%? You don't know, right? Look at the great financial crisis. A lot of people thought it was going to stop at 4, and then it went to 5, and then they thought it could stop at 6, and then it went to 7, and then it went to 8, and then it went to 9, right? So a little food for thought in regards to that. It didn't go to like a 10. You're also seeing things like this. Red Lobster abruptly closing dozens of restaurants. Struggling Red Lobster, which didn't they have bomb biscuits back in the day? I never went there, so I can't talk on that. But I think people used to like their biscuits. Red Lobster closed at least 48 of its restaurants around the country here very recently, leading to a restaurant liquidator. I went for sushi at one of my favorite sushi places in Vegas, and went with my family, went with my wife and my 3 children, and it was fascinating because food was phenomenal, by the way, as always. But my 2-year-old started, getting fussy, acting up, terrible twos type stuff. So, I was done eating, so I said, okay, I'm going to go walk around with him while you guys kind of finish up here. So my wife and my other 2 kids, they finished up eating and whatnot, right? And so I take my 2-year-old on a walk around the plaza. It was really fascinating what I had seen. this whole plaza is basically out of business now at this point in time. And keep in mind, this is actually a plaza in a pretty wealthy area. Like, average income in this particular area is like $90,000 plus. And so there's no reason that, like, this is not in some like low income area or something like that. Let's just put it that way. They had the sushi place in business and the coffee shop in business. The entire rest of the plaza was out of business. No lie. The entire rest of the plaza. Now, this is in one of those strip malls that, usually attracts a lot of mom and pop type places, whether it's restaurants or, hair salon or nail place or, a little retail store or dry cleaners or all those sorts of businesses. The whole freaking plaza was out of business. I'm like, what is going on here? But that I have seen a little bit of a bigger trend of that here recently, where I've seen some of the weaker restaurants go under recently and other things. And I think there's a lot of reasons for this. I think part of it is because you can't get employees because unemployment rate's so low. If you do get employees, you got to pay an arm and a leg for them. You're so desperate for employees that maybe you're more likely to hire anybody, and those people do a bad job, which then sends away customers, and then you lose business, right? Rents have obviously probably dramatically increased over the years. The cost of doing business has, and then you might not be able to offset that with your customers. So the bottom line is only the strong survive in business right now. And it's becoming more and more apparent as the quarters are ticking on that only the strongest of the strong will survive. Now, that's the suburbs of kind of Vegas that I'm starting to see some trends emerging here. But then you look at the Strip, and the Strip is phenomenal. The Strip business has been great. You listen to what MGM has to say or Caesars has to say or what Wynn Resorts has to say. It's very, very good. Wynn Resorts numbers just came out this past week. Look at Vegas specific. This is their Las Vegas operations. Wynn and Encore on the Las Vegas Strip. Now, there's one bad thing you could say, and that's gaming revenue. Gaming revenue on the Las Vegas Strip was down considerably, down about 12.5%. Now, you could look at that and you could run with, oh boy, the recession's here. Gaming revenue at the Wynn down 12.5%. That's it. But not so fast, because rooms revenue was up 21% for them year over year. Food and beverage was up 12% for them year over year. And entertainment was up 12% plus year over year for them. Overall revenue was up 8.5%. So yeah, the gaming business was a little weak, but other businesses are so strong. 8.5%, that's way above CPI. Adjusted EBITDA, 6.3% growth year over year. Occupancy, a little weaker than last year, but it's not enough to really say, ooh, there's a big problem at Wynn. 88.8% versus 88%. Yeah, it's a little weaker, but it's not like there's nothing there that slaps you in the face and says, oh boy, there's a recession. It's bad. It's here. Here it is, right? You look at the Boston property. They got their Boston property, right? That's one that if you really felt like there was a recession here in the United States, you're going to see Boston property get bad. There's nothing there that's obvious. Look at total revenue. It was actually up very slightly. Adjusted property EBITDA, that down very slightly. Occupancy, down very slightly, 89.7% versus 90%. There's nothing there that you can say, boom, there's it. It's obvious. Nothing. You look at their overall numbers, they're great, A- quarter, but keep in mind a lot of that greatness is because of China overall, so do keep that in mind. Then you look at tech companies. Oh my gosh, look at Palantir. They got an A quarter here. They're having no trouble getting business, right? Their gross profit exploded year over year. Their revenue exploded year over year. Their income from operations around 20x year over year. Their net income went to the moon. You look at a company like PayPal, which PayPal is commerce. PayPal's commerce, right? Look at PayPal's numbers. I mean, these numbers are phenomenal. PayPal, are you flipping my flapjacks? PayPal, $7.7 billion of revenue versus around $7. The same. So basically, they're doing about, a little under $700 million more in revenue versus this time last year. Their diluted EPS went to 83 cents versus 70 cents. Their net income went to 880 million. It's a very good quarter from PayPal. That is commerce, right? Look at Amazon. It doesn't get better than Amazon. It's an A+ quarter for Amazon. Look at total net sales, 143 billion versus 127 billion. Oh my gosh. Look at net income. It over 3x for the company year over year. Over $10 billion they did in net income versus 3.1. Now, there was one bad thing with Amazon. One bad thing. Only one. The only bad thing you could say with Amazon was their guidance came in a little weak, right? But it was a little weak. It wasn't like off a cliff. So that's one of those things you look at and you're like, if you're lean bearish, you could say, oh, revenues came in a little weak as far as their guidance, so therefore recession, right? If you look bullish and you say, you know what, that's just a little one-off thing there, they're probably sandbagging, blah, blah, blah. So, looking at Amazon's numbers, how can you make a recession call when Amazon's got three major businesses, right? Their e-commerce business, advertising, and AWS. It's hard to make a recession call when revenue for Amazon was up $16 billion year over year. $16 billion when your net income's 3xing year over year over that. It's hard to make a recession call, right? You look at Supermicro, one of the most talked about stocks in the market. They had a very nice B plus quarter. Their net income's exploding. Their revenue's exploding for the company, right? Look at Mr. Softy. That's an A quarter there. Phenomenal. Look at this. Total revenue, nearly $62 billion versus $52.8 in the same quarter last year. Hard to make a recession call on Microsoft. Look, Google McDougal, obviously very reliant on advertising. Google revenues were up over $10 billion year over year. EPS exploded for the company. Look at Meta. Doesn't get better than Meta. It's a grade A quarter out of this company, right? I mean, look at what happened. Revenues went to $36.4 billion versus $28.6. Look at what happened at EPS. Look at what happened to net income. That's hard to make a recession call. But then, problems emerge. Big problems. You go outside of tech and you find a lot of problems. Look at UPS. UPS revenues down 5.3%. Why? UPS revenues should never be down. I mean, technically, if the economy is always getting bigger, you would expect a company like UPS, that is the transportation service of, the economy really, you would expect their revenues to basically be going up every year. To see revenues down 5.3% when you got 3.5% CPI or whatever, it doesn't seem right. It's a problem. And then look at their bottom lines. Total operating profit fell 36.5%. Net income fell over 41% for the company. 41%. What in the world? Literally, you look at UPS numbers, you would think we're in the biggest recession of all time. You would think we're in the great financial crisis right now. You think we're in the Great Depression looking at UPS numbers. Revenues downtrending? Earnings per share down 40+%? Come on, what's going on here? You look at a Caterpillar. How did Caterpillar's revenues go down year over year? How is that even possible when you think about everything that's going on right now? Look at Southwest Airlines. They don't have a revenue problem, but boy, do they have a bottom line problem. Operating loss jumped over 38% for the company. Net loss jumped over 45% for the company year over year. Look at Whirlpool. This is the economy, right? You think about appliances, refrigerators and ovens and washers and dryers and all these things. I mean, isn't it a great F quarter? Just a complete dumpster fire at Whirlpool. Complete dumpster fire. And then you look at a Starbucks, right? Starbucks, you say, you could make excuses for Starbucks. And you could say, you know what? There's a lot of other coffee shops or competition. You can make excuses and say, you know what? It's those boycott things because Starbucks got caught up into some situation. You can make whatever excuses you want to make up for Starbucks. But at the end of the day, the fact is Starbucks operating income fell 17.2% and their net income fell 15%. And Starbucks is a company you expect to grow every year. Like you never expect Starbucks to have their operating income fall off a cliff and their net income. They just shouldn't happen ever for Starbucks. So to see that, it's pretty eye-opening, right? That's a grade D quarter. You look at somebody like a Lucid. Oh my gosh, it's Lucid Dreams. Come on. Lucid F quarter. Their loss from operations, $729 million. Their loss from operations over $200 million a month. A month. Their net loss, $680 million. You're gonna be flipping my flapjack. Come on, man. Like, if the Saudis don't keep giving Lucid money, it'll be a year from now, 2 years from now, and all those employees that work for Lucid will unfortunately lose their jobs. Their factories will shut down. Like the Saudis got to keep piling money in there. Lucid's not going to make it, man. Bottom line with that. But then you see Cheesecake Factory earnings. You say, okay, you know what? If there's real weakness in the economy, we got to see it show up in restaurant earnings. Well, but Cheesecake Factory, A- quarter. Revenues, $891 million versus $866 in the same quarter last year. Their net income was up over $5 million year over year. $33 million in net income they just did versus $28 million in the same quarter last year. Diluted EPS, 68 cents versus 56 cents. So Cheesecake Factory looks great, right? But Cheesecake Factory for the restaurant industry is kind of like what NVIDIA or Meta is, or for the tech industry, right? Then you look at treasury yields. So if you think about cash as trash, right, you also have to have the belief that there's nowhere to put your money, right? But then you look at treasury yields, 3-month yielding 5% plus, 6-month yielding 5% plus, 12. There's places to put money to. It's not like, you just are stuck with cash under the mattress getting devalued. No, you can put it there and you can earn good rates. A lot of good online savings accounts, 4.5% plus. Now, yield curve has been inverted for a long time. Yield curve inversion started getting talked about a lot. Actually, it was at the end of 2021. It started getting talked about a lot, but then in 2022. And the reason being is because yield curve obviously inverted. Now, a lot of people get confused when they think about yield curve inversion. They think that means recession. Not technically, okay? And by the way, yield curve has been inverted for a long time now at this point in time. But here's the deal. You've got to worry about yield curve when it uninverts. So when the 10 and 2 then flip the other way, that's when you actually got to start to worry, okay? So for instance, the yield curve truly really uninverted. I would say October 2007, you could start to make an argument that, okay, the yield curve's finally really uninverted, because before that, it might go a little bit above, but then it would drop right back down. That was when it was sustainable, like, okay, we're way out of yield curve inversion now at this point in time. It's done, right? But the problem was, then the economy really obviously took a tumble as 2007 went along, and then obviously 08, 09, things got really ugly. And so that's when you actually got to start to worry, is when that uninversion happens. So right now is usually not the time period you really got to worry. It's once this number goes, once we get back above this line sustainably, that's when usually you got to go, problems are coming, okay, for the economy. A little food for thought in regards to that. Now you look back to the late 70s, early 80s, it was a messy time. And what this led to was massive unemployment, right? Look at the unemployment rates in the late 70s into the early 80s. I mean, many of those years we were 7% plus. Unemployment rate, absolutely brutal. So just a little food for thought in regards to that. Now, we had a good trend going for a while there in terms of real wages going up and up and up and up and up. But we flipped the wrong way, okay? And so real wages, looking at, what's your wages versus inflation and how much your wages are increasing versus inflation, right? Recently, it started to go the wrong way again. That's a little troublesome. We were on a kind of a good trend there. That's not good, okay? So given all the data we just looked at, which that was a lot of data, okay? I do not think cash is trash. It's a valuable asset if you can make 5% plus on it right now, risk-free, in a savings account that's, guaranteed to 250K plus, or you got treasuries, right? I don't think is trash at all, in my personal opinion. I think too much cash is a little clownish. I will say that, right? You can't call tops in the economy. You can't call tops in the market. You can't call tops in individual stocks. No one can. I can't. I do this all day, every day, right? Been in this game for 15 plus years. I can't do it. Ask any legendary investor. Ask Warren Buffett. Ask Ray Dalio. Ask anybody you want to ask. They'll all tell you they can't do it either. They can't do it, right? Big Buffett. I love Buffett. Buffett, the GOAT. I mean, I learned more from him than anybody, I think, that's a celebrity in the investing space. Berkshire's up to $188 billion in cash. They're expecting to hit $200 billion or more by June, right? Buffett says, we'd love to spend it, but we won't spend it unless we think we're doing something that has very little risk and we can make us a lot of money, right? And you might look at something like that and you might say, you know what, Buffett's so heavy cash, he knows something coming. The fact is, Buffett's been insanely heavy cash for 5+ years. This isn't new. The cash pile just keeps growing because they make so much money. But the fact is, Buffett's been insanely heavy cash for a long time now at this point in time. And then you take into account, what's the 5-year return on the NASDAQ? We're not talking about buying individual stocks, just putting money in the NASDAQ. 101% in the past 5 years? I mean, Berkshire would have a whole lot more money if they just put their money in the NASDAQ, just to be quite frank, than having to sit there in cash. And so that just goes to show, Buffett's been heavy cash for 5+ years, and ultimately he's missed out on an incredible amount of opportunities. And so at some point in time, maybe the economy goes south, things happen. Maybe it's this year, maybe it's next year, maybe it's 2 years, 4 years, 6 years from now. And hopefully they can deploy some of that cash out there. But the problem is they might be buying still at much higher prices than when they started building that insane amount of cash, right? So that's where you don't want to get too heavy cash. So my personal opinion, perfect amount of cash is 10%. 10% or more. I think minimum 10% cash right now makes a lot of sense. So for instance, you have a $10,000 stock portfolio, have $1,000 plus yielding you 5%. Once again, don't just have it sitting there doing nothing. Get that 5%. If you have $50,000 stock portfolio, have at least $5,000 getting you 5% plus. You got a $250,000 portfolio, have $25,000 plus earning you 5%. You got a $750,000 stock portfolio, you're doing well for yourself. And have $75,000 plus yielding you 5% right now. Okay, so if I looked at myself, I got $2 million in the public account. So let's say the public account was my only portfolio. I didn't have money in other portfolios, which obviously I do. But let's say that was my only portfolio. That would mean I need to have at least $200,000 in cash, right? Or, money just earning me 5% right now, right? Which is not a small amount of money. Do the math on $200,000 at 5%. That's quite a bit. And so that puts me in a position where, yes, I'm heavily invested in the market. I'm capitalizing on all these great companies that are earning, insane amounts of money, right? But I'm also ready for, if this thing really takes a turn for the worst, right? If we're really in a Titanic situation, right? I got all that money that's sitting there, right? So, just understand, I got a lot of cash around right now. I got a lot of cash. You want to know how much? You want to know how much? You want to know how much? I'm not going to tell you how much. You kidding me? You think I'm going to tell you how much cash I have around? No. But it's a big number. That's what I will say. It was a big number. And so I'm heavily invested. Got a lot of money out there, but I also got a lot of money in cash. That's ready, just in case. Because I do look at that data and I say, man, there's a lot of things here that aren't that great. The good news is when you do look at a lot of things and they're not that great, there are a lot of things that could improve. Always keep that in mind as well, folks, okay? Hope you enjoyed this absolute beast of a video here today. If you enjoyed this one, you're going to enjoy that workshop even more. It's an absolutely free workshop to get there. It's a pinned comment down there. I can email that over to you. And this workshop is going to take you through each of these 7 steps to reach $1 million plus in your portfolio, growth hacks to reach and scale faster, and how to implement those 7 steps. Pinned comment down there. Much love and have a great day.